I've learned that the most dangerous financial risks don't look like fireworks. They look like a slow leak in a quiet room. No alarm, no headline, just a quiet mismatch between what's been promised and what can be paid. The older I get, the more I see the same pattern. People think the danger is a crash. The real danger is the gap. The gap between the story we've been told and the math that will actually show up in our accounts. If you're a retiree or close to it, you can feel that gap without anyone explaining it. You worked, saved, paid into systems that promised security. And now you sense a larger storm than any single market drop. Pensions getting trimmed. Costs that go up faster than you can adjust. Guarantees with asterisks. It's unsettling because you didn't do anything wrong. You did the responsible thing. And yet the ground feels less certain. Welcome to Quiet Wealth. I'm not here to scare you. I'm here to put words and math to the feeling you've been carrying. The feeling that, at a national level, we've promised more than the real economy can safely deliver at the price we'd like. I've seen versions of this before. And I've seen how ordinary people build safety anyway. I'm in my 90s now. I've been investing, making mistakes, and waiting for a very long time. I remember when inflation felt like a daily weather report, when a gallon of milk jumped and nobody blinked. I remember pensions that looked solid until they admitted they'd been using return assumptions that belonged to fairy tales. I remember 1,987 inches a single day, and 2,000 over 3 years, and 2,008 inches slow motion. I remember how scary 2020 looked when everything shut down. Each time, the story was that this time is different. In detail, yes. In human behavior, not really. I've made my share of mistakes. I've overestimated cash flows, underestimated costs, and believed narratives that were clean and comforting. The humbling thing about decades is that they don't just grow your money, they grow your humility. You come to respect the difference between what you want to be true and what the cash register says at closing time. Here's what I've observed across cycles. What breaks people isn't a lack of intelligence, it's a lack of margin. They enter retirement with schedules built on everything going right. They depend on a single promise, a pension, a yield, a number on a spreadsheet that doesn't bend. Then life bends. Markets deliver lower returns for a few years. Healthcare surprises. A child needs help. That's what breaks the plan. Not catastrophe. Fragility. If you're worried about the big number 50 trillion, 70 trillion, pick your headline, you're not crazy. At a national level, promises are tall. State pensions, federal promises, healthcare liabilities, insurance guarantees. Households were told that the math to fund it all is easy. 8% a year forever, 2% inflation forever, tax rates that never move, markets that only go in one direction, interrupted by polite dips that recover in a month. Smart people believe things that aren't durable because they're simply trying to live a normal life. They don't have time to audit actuarial tables and long-term productivity growth. They trust their employer, their union, their government, their broker. They think a line on a statement equals money in a vault. Let's put it plainly. The system-level promises are larger than the system's guaranteed cash flows. That doesn't mean collapse. It means adjustment. And adjustment is paid for by somebody. Sometimes it's paid by inflation, sometimes by slower benefit growth, sometimes by later retirement ages or higher taxes, sometimes by lower asset returns for longer than people hope. When you sense this, you're picking up on something real, and yet there is a path to calm. It begins with a simple reframe. You are not a passenger on the national bus. You are the chief financial officer of your personal economy. You do not need the entire system to keep every promise for you to be okay. You need a plan where your basic life can be funded by things close to certainty, and your wants can be funded by things with variability, and your choices can flex when reality misses the brochure. The old dream was maximum growth. The new reality is minimum required return. Your freedom is not determined by how high your assets can climb. It's determined by how low your required draw can fall. If you can bring your essential expenses down to a number that can be covered by safe, boring cash flows, you win. Everything else becomes optional. That is how you build a moat around retirement. Not by predicting markets, but by making markets less important to your survival. This isn't impressive math. It's boring math. And boring math is what makes people wealthy enough to sleep. Let me show you the kind of math I mean. Imagine you need $50,000 a year to live a life that feels dignified. Not fancy, dignified. Roof that doesn't leak, food that's healthy, heat in the winter, a modest car, a few trips to see grandchildren. If your portfolio is $1 million and you plan to draw 5%, that's your $50,000. On paper, it works. But the world doesn't pay you on paper. Real returns wobble. Taxes nibble. Fees nibble. Health costs don't read your plan. Now, imagine you bring that $50,000 down to $40,000 by making 2 or 3 durable adjustments. You move from the high-tax zip code to a lower one that is still close to family. You pay off the mortgage. You stop trying to ensure a lifestyle you don't actually enjoy. Now you only need $40,000 a year reliably. What does that do to the math? At a 3.3% withdrawal rate, boring, conservative, you need roughly $1.2 million to feel comfortable with $40,000. At 4%, you need $1 million. But here's the gentle shock. Every permanent $1,000 of annual expense requires roughly $25,000 to $33,000 of investable capital, depending on your draw rate. Cut $4,000 of permanent expense, and you just relieved yourself of the need to amass $100,000 to $132,000. That's not sexy. That's sanity. Inflation is quiet but relentless. At 3%, prices double roughly every 24 years. If you're retired in your mid-60s, you might see that doubling. That $50 haircut becomes $100. That $300 grocery run becomes $600. The way you protect yourself isn't by trying to outrun inflation with risk you can't stomach. You protect yourself by separating needs from wants and funding needs with cash flows that don't panic. You let the wants float with the market. Now, sequence of returns. Imagine 2 retirees with the same $1 million and the same average return over 30 years. One experiences poor returns in the first 5 years, then good returns. The other experiences the reverse. The average is the same, but the outcome isn't. The one who faced poor returns early might deplete faster if they keep spending the same. The defense is simple: flexibility. If your rule is, we'll take a modest raise in good years and freeze or trim 5 to 10% after bad years, you've done more for your longevity than a dozen spreadsheets. Flexibility beats bravado. What about safe cash flows today? The good news is that in periods when short-term interest rates aren't at zero, boring assets pay again. Treasury bills, short-term treasuries, high-quality bonds. You can build a ladder, a year of expenses in cash, 2 to 4 years in very safe, short-term bonds, the rest in productive assets that can grow over time, businesses you own through low-cost index funds or a thoughtfully chosen group of dividend growers. That way, you buy yourself time. If stocks are down this year and next, you're not selling your future at a discount to buy groceries. You've funded groceries already. Another piece of boring math people don't like to hear. If your plan only works when everything hits the high end of the range, it's not a plan. It's hope dressed up as a chart. Build plans that survive the lower bound. If your asset mix can reasonably support a 3 to 3.5% draw through a nasty decade and still recover, you have margin. If it only works at 5% in a world that isn't offering that safely, you don't have margin. And retirees need margin more than they need excitement. Now, let me share some principles that have kept real people safe when the world got noisy. Not as a checklist, but as lived choices. I knew a couple in Ohio who retired right before the dot-com bust. They had a modest pension, a small IRA, and a paid-off house. They weren't interested in the latest tech stock. They were interested in Saturday breakfasts and visiting grandkids twice a year. Their secret wasn't an investment trick. It was a decision, no debt, and a low fixed-cost life. That paid-off house behaved like a bond for them. No rent, no variable payment. Property taxes rose, yes, but their biggest expense didn't move with interest rates or job loss. When markets fell, they didn't panic because their roof didn't care what the S&P was doing. Lesson: reducing fixed costs is the safest yield you will ever find. $1 of cost permanently removed is $1 of after-tax, risk-free return. I think of a man who retired from a factory in the late 1970s, a time when inflation made plans look foolish. He survived by keeping 3 buckets, though he never called them that. He kept a year's worth of expenses in cash in a coffee can, a few years' worth in certificates of deposit, and the rest in a handful of sturdy businesses he understood. He never had to sell the businesses at a bad time to buy groceries. That simple buffer turned volatility into a nuisance instead of a crisis. Lesson: time is your shield. Buy it with cash and short-term safety so you can leave the productive assets alone when they're temporarily cheap. Yield is seductive. I've seen retirees chase a high dividend like a moth to a porch light. The yield looks safe until the business cuts it, and then you lose income and the stock price. High yield often signals higher risk. Be wary of anything that needs to shout to get your attention. The quiet businesses that raise their dividends gently over decades don't brag, they just show up. And broad markets, bought through low-cost funds, don't need to impress you, they need time. Lesson: own productive assets that don't require your genius. Pick vehicles that let you benefit from the work of millions without betting your life on a single promise. There's a quiet strategy for sequence risk that many miss. Adjust your draw with a simple guardrail. If your portfolio drops by, say, 15% from last year, take a modest pay cut, 5 to 10% for a year or two. If it rises and exceeds a prior high, give yourself a raise, but not as high as the markets rise. Let your lifestyle lag the market on the way up and down. Over time, you smooth the ride. You'll find that giving yourself a pay cut for a year is cheaper than running out of money 10 years early. Lesson: flexibility is worth more than a hot return. Social Security is not a lottery ticket or a scam. It's a piece of a retirement income puzzle. The math is simple. For many, delaying claiming increases your guaranteed monthly benefit. If you're healthy and longevity runs in your family, waiting can raise your lifetime payout. If you're not healthy or you simply need the income, take it. There's no perfect for everyone, only appropriate for you. Think of Social Security as a base layer, like a floor. The other layers can move more. Lesson: treat guaranteed income like the bricks in your foundation. Make them as strong as you reasonably can. Annuities are a controversial word because they've been sold poorly. But a simple, immediate annuity, one that starts paying right away, no bells and whistles, can function like a private pension. It turns a slice of your savings into a lifetime paycheck. The trade is liquidity. You give up control over that principle for predictability. For some, using a portion of assets to cover the absolute basics through a plain vanilla annuity adds sleep. For others, the cost is too high. The principle is this: match safe, guaranteed income to your must-pay bills, and let your market assets cover the rest. It's okay to build your own pension if the ones you counted on are uncertain. Just beware fees and complexity. Lesson: simplicity outlasts cleverness. Taxes don't make headlines until April, but they leak money from retirees every month. Remember, money spent is after tax. Money saved often reduces tax. Where you pull cash from matters. Sometimes paying modest taxes sooner, converting a slice of a traditional IRA to a Roth in a low-income year, can lower lifetime taxes. Sometimes spending from a taxable account while letting tax-deferred accounts grow a bit more makes sense. The point isn't to play tax games, it's to pay taxes when they are cheapest for you. Lesson: sequence your withdrawals with intention. Keep more of what you already earned. Health is the asset that makes everything else usable. A dollar not spent on preventable health issues is a dollar that grows your margin. Walk the neighborhood, plant a garden, see the doctor before small problems become large ones. Modify the house early to avoid a fall that changes everything. Long-term care is the elephant nobody wants to discuss. You can buy insurance, but policies change, and premiums can surprise. Another strategy is to plan for it with living arrangements and family agreements. Move closer to adult children before it becomes urgent. Identify a home you could downsize into that is safer and cheaper. That plan is a form of insurance too. Lesson: invest early in the life that will cost you less later. Avoid leverage. I can't say this strongly enough. Do not borrow against your portfolio for lifestyle. Margin loans are the devil in a silk suit. They look sophisticated, and they work until they don't. When markets fall, they don't just take your return, they take your sleep. Retirement is a place for the opposite of leverage. Cash buffers, paid-off assets, flexibility. Lesson: if something promises you comfort without patience, it's probably selling you leverage in disguise. Finally, cultivate optionality that isn't financial. The most powerful inflows in retirement often don't come from a brokerage account. They come from a hobby that becomes a small income, a skill that still earns a little, a room you can rent if you want to, a neighbor who wants to pay you to teach their child piano, a church community that shares tools and time. These aren't line items on a budget. They're shock absorbers. When the world wobbles, they keep your life upright. Lesson: relationships, skills, and community are assets. They compound too. Now let's address the fear directly. The 50 trillion crisis. Whether we tally unfunded obligations, underfunded pensions, healthcare promises, or debt that expects growth to pay it forward, the big number is there. It looks back at you from headlines and makes you feel small. Here's the truth you can use. Those numbers will be managed the way big numbers always are, slowly, politically, with a mixture of inflation, growth, delay, and adjustment. They'll be argued about on screens by people who get paid to be loud. Your job is quieter. Your job is to make sure that your essential life is funded by streams of cash that don't need permission from markets or politicians to arrive on time. So, you build your personal pension. What does that look like in practice? First, you define your floor. You list the expenses that define a life of dignity, not a life of envy. A life of dignity: housing, food, utilities, healthcare basics, essential transportation, modest giving, basic connectivity. You total that number. You fund that number with a mix of social security, maybe a pension if it's strong, maybe a basic annuity if appropriate, and the dependable slice of your portfolio, treasury ladders, high-quality bond ladders. You aim to get that floor covered before you ask your equities to do the heavy lifting. Once the floor is secure, you set aside 2 to 5 years of optionality for the next level travel. Nicer car, gifts funded by a combination of dividends, interest, and, when markets are kind, harvest from stocks. Second, you reduce the permanence of your optional expenses. Instead of a gym contract, buy weights that last. Instead of a high HOA community, choose a place where you aren't paying for amenities you don't use. Instead of rigid travel plans, Travel when prices are low. Permanently lower fixed costs are better than temporary high returns. Third, you adopt a policy of patience and small moves. Change one major cost per year. Refinance or pay off something. Downsize a little if it buys a lot of margin. Learn to love the feeling of a simpler spreadsheet. There's a peace that comes from fewer lines. Fourth, you decide in advance how you will respond when markets drop. You write your own letter to your future self. When the market falls by 25%, I will do nothing rash. I will live on the cash and bonds I already set aside. I will not sell my best businesses because other people are afraid. I will prune my spending by a small amount. I will give my future self the gift of holding. You put that letter in a place you'll see when the news gets loud. Fifth, you safeguard your mind. Noise is expensive. Turn down the television that tells you the world is ending every week. The world rarely ends, but portfolios end all the time by people who couldn't wait. Read a little history. Talk to someone older than you who's seen more winters. Remember, markets are voting machines in the short run and weighing machines in the long run. The weight is earnings, productivity, creativity. Those tend to rise over time. Let's talk about the home, because it's where most of your life happens. A paid-off home is more than shelter. It's a psychological anchor. But even a paid-off home can drain you if it's too large, too far, too expensive to maintain. Downsizing isn't defeat. It's a trade, complexity for margin. A small, warm home near people you love can lower your expenses, your loneliness, and your risk. That's a triple return, and it's one of the few places where a decision today can improve your finances for 2 decades without any market luck. Some of you are caring for adult children or grandchildren. That's love. Just remember that in an airplane, the instruction is always the same. Mask yourself first. You cannot save your family by sacrificing your stability. You save them by being a steady presence for a long time. Set boundaries that honor your limits. Offer skills, housing, time, not only cash. $1 spent today that empties your reserves could be $10 you don't have 10 years from now. Now let's zoom out 30 years. Just for a moment. Imagine you're in your 90s. The headlines of 2025 are faded. That $50 trillion number changed shape many times. Policies came and went. Interest rates danced. Elections swung. None of that turned your lights off because your lights weren't powered by the headlines. They were powered by a plan you could explain to a child. You owned pieces of productive companies that, despite recessions and disruptions, found ways to make things people wanted. You collected dividends and interest. You kept a cushion. You didn't sell your future at a discount to buy your present. You didn't buy the biggest house you could afford when you were 70. You bought the house you enjoyed paying for at 85. You didn't stretch for 1% more return. You cut 5% of expense that didn't bring you joy. You didn't panic during the bad years. You took a modest pay cut and waited. And then one day, the market bounced back like it tends to, and you were still there to benefit. The big money, in every season I've lived through, was made in the waiting. Not waiting and doing nothing. Waiting while holding good assets, rejecting silly risks, and trimming your lifestyle to match reality. Wealth is what you don't need to spend. Freedom is the gap between your necessities and your dependable income. Peace is knowing that gap won't close when someone else breaks a promise. You will hear dramatic words about collapse, crisis, and catastrophe. Let me offer you a quieter word: resilience. Resilience is built in preparation, not prediction. It's built by paying off the small debts, by choosing the smaller fixed bill, by keeping some cash close and your eyes on the long term. It's built by understanding that no one is coming to save you, and realizing that you are capable of saving yourself by making small, conscious choices that compound. One last reflection. In my life, I've found that money is a tool, not a score, not a mirror, a tool. Tools are made to do jobs. The job of money in retirement is to buy you time and choices. The choice to say no. The time to sit with a cup of coffee and a friend without checking the market. The choices that let you keep your dignity when someone offers you a deal that sounds too good. The time to help a neighbor, to read, to walk after dinner, to tell stories to a child who doesn't care about your net worth. If you feel like you're standing on a bridge that's shaking, step off the headline bridge and stand on a foundation you can control. Build your floor. Keep your cushion. Own productive assets that don't depend on you being clever. Spend less on things you won't remember. Spend more on health and relationships. Write down your rules for when the world gets loud. Then live quietly by them. If you enjoy this kind of quiet, long-term thinking, you might enjoy what we do here at Quiet Wealth. You're welcome to subscribe. You don't need the world to behave. You need your plan to behave. Let others argue the big numbers. You take care of the small numbers that pay your bills and guard your sleep. That's how you get through storms. That's how you outlast a crisis that was always coming. Because promises always grow faster than prudence. You meet it with prudence. And you win by being the last person still standing, with a clear head and a simple plan. You've got more control than you think. Not over policy, over your life, over your burn rate, over where you live, what you drive, what you expect, and what you refuse to gamble. You'll find, as I have, that the calmest wealth is built by people who learn to enjoy a less expensive life and a more abundant day. They don't waste time chasing every point of return. They take the return the world is offering and hedge the rest with patience and margin. The $50 trillion crisis isn't a thunderbolt. It's a tide. You don't outrun a tide. You step back from the edge. You build on higher ground, and you let the water come and go without taking you with it. That higher ground is a paid-off home, a low fixed-cost life, a cushion of safe cash, a stream of dependable income, a basket of productive companies, a flexible spending plan, and a community that doesn't let you fall alone. If that sounds simple, it's because it is. The hard part is not knowing. The hard part is doing it consistently while the world tries to sell you something. Keep it boring, keep it steady, keep it yours. I'll leave you with a small rule that has weathered the years for me. When in doubt, choose the option that increases your margin and your options a decade from now. That choice adds a quiet compound interest to your life that no crisis can take. Thank you for spending this time with me. Take a walk after this. Look at the sky. Remember that markets are loud because they're short-term. Wealth is quiet because it thinks long-term. Build the quiet kind. That's the kind that sees you through.